Income from house property. Income Tax Act 1961. Lesson 8. Income from house property. Good morning, everybody. I am Mr. T.B.Agarwal, retired income tax officer, speaking from Agarwal Income Tax Tuition Classes, Akola. We have learned that the annual value of property as determined under Section 23(1) is to be taken as taxable as income from house property. Now this annual value is to be arrived at, and how this annual value is to be arrived at is given in section 23(1)(a), b, c of the act. That is section 23(a) subsection a, b, c, which we have already studied in the last video. It is like this: a, the sum for which the property might reasonably be expected to let from year to year, or b, where the property or any part of the property is let and the actual rent received or receivable is more than the reasonably expected rent referred to in clause A above, then this higher amount so arrived at or receivable or received will be considered. Or C, where the property is let and was vacant during the whole or any part of the previous year, and owing to such vacancy, the actual rent received or receivable by the owner is less than the sum referred to in clause A above, then the amount so received or receivable. Now we can understand that if the actual rent received or receivable by the owner is in excess of clause A, then this amount will be the annual value for taxation purposes. We have also noticed that the income from house property is computed from two types of properties. One, let out property, and two, self-occupied property. That is SOP in short. First, we will see the case of let out property out of the two types of properties mentioned in the last video. Now, there cannot be two opinions about the receipt of actual rent by the owner as in clause B above. But where the property is let out, the question arises as to what will be the reasonable rent expected to let from year to year. How can this be decided? Because here we have to take higher of the expected rent or rent received. The owner of the house property may say that this particular or specified amount can be expected as reasonable rent, and the income tax department may say that this sum is not fair and it can be more than this amount as reasonably expected rent. The language of the act does not clarify the same, and the ambiguity remains, because in determining the reasonableness of rent, many factors or things have to be taken into consideration, like location of the property, rent of similar properties in neighborhood, or value fixed by municipality, demands of houses in such area, etc. Therefore, after considering all these facts and various court decisions, in majority of cases, the expected rent can be determined by taking into consideration the following formula or rule in cases of let out properties. A, municipal valuation of the property, that is MV. B, fair rent of the property, that is FR, means rent fetched by similar property in the same or similar locality. The higher of the above A or B is generally accepted as expected rent. And C, however, if the property is covered under the Rent Control Act, then the rent fixed under the Rent Control Act will be taken as annual value. Means the higher amount from A or B will be taken, but it should not be more than C. Higher amount of A or B cannot exceed the C, that is the rent fixed by the Rent Control Act, which is called standard rent, SR. Therefore, the formula can be MV or FR, whichever is higher, limited to SR. The expected rent can be lower than the SR, that is, the expected rent can be lower than the standard rent, but it cannot exceed it. This issue, however, does not arise in case of self-occupied properties because the annual value of this property is to be taken at nil. This can be clarified in example as under. Annual value of house properties A, B, C. Property A, property B, property C. That is municipal valuation. Property A 40, B 40, C 40. Fair rent A 46, B 48, C 51. Annual value will be higher of the above, that is in case of A 46, in case of B 48 and in case of C 51. But it is limited to SR, means standard rent, which is in case of property not applicable. So this property is not covered under the Rent Control Act, so it is not applicable. In case of property B 45, in case of property C 63. Therefore annual value will be in case of A 46, in case of B 45 and in case of C it will be 51. The reasonable expected rent can be lower than the standard rent, but it cannot be more than standard rent, or it cannot exceed the standard rent fixed under the Rent Control Act. Now the computation of the income from let out house property will be as under. Annual value less municipal taxes paid under section 23, balance less 30% standard deduction under section 24, then remaining balance, then that from that balance we have to deduct interest under section 24 on borrowed capital for acquiring or construction of the property, and then the balance is income from house property. Here the word municipal taxes paid is important. If the municipal tax is payable and not paid during the financial year, then for that amount deduction will not be allowed. Here the words rent received or receivable are also very important, and why the word receivable is used in the clause will be discussed in later lectures, as it is not required here for purpose of examination, but it is a matter of general discussion. The students have only to compute the income on the basis of information given in the question paper. So now we will proceed further to see the computation of income from self-occupied house property, that is SOP in short. The procedure of computation of income from this type of property is the same as in the case of let-out property. The only difference is that in case of SOP, the annual value is to be taken as nil, and we have not to go by the formula of municipal valuation or fair rent, etc. So if the value is nil, then there is no question of allowing deduction for municipal taxes, as the income is determined at nil, and a standard deduction of 30% of the annual value will also be nil. So the only deduction allowable from the annual value, which is nil, in such case will be for amount of interest paid or payable on the loan borrowed for acquisition or for construction of such house property. This may result in loss or minus income from house property. The amount of interest to be allowed as deduction under section 24 in case of SOP is, however, limited to 2 lakhs of rupees only. Here the point be noted or kept in mind that as per the terms of section 23(2)(a) of the Act, that is in case of self-occupied property, the annual value of property is nil, and as such no other deduction is allowed except by way of interest on borrowed loans for purpose of construction of the house property. The second point is that where the SOP is acquired or constructed with the funds borrowed on or after 1/4/1999, means 1st April 1999, within 5 years from the end of the financial year in which the loan is taken, then the deduction of interest can be allowed up to 2 lakhs of rupees. Otherwise, the amount of interest allowable will be 30,000 only. Further, the important point is that to get the deduction of interest up to 2 lakh rupees, the loan should be for acquiring or constructing the property. If the fund is borrowed for reconstruction or for repairs or for renewal of the house property, then the maximum amount of deduction on account of interest is rupees 30,000 rupees only and not rupees 2 lakhs rupees. The amount of interest for pre-construction period will be allowable in 5 equal installments from the previous year in which the property is acquired or constructed. Now we will see an example as under. Letter property and SOP. MV 50,000 rupees, 1 lakh rupees. Fair rent 60,000 rupees, 1 lakh 25,000 rupees. Municipal taxes paid 2,000 rupees and 10,000 rupees. Fire insurance paid 50,500 rupees and 2,000 rupees. Interest on loan 3,500 and in SOP it is 8,000 rupees. Compound income from house property. Now see the solution. Annual value higher of the above, that is 60,000 in case of letter property, and SOP it will be nil. Less municipal taxes in case of letter property 2,000 rupees and SOP nil. Balance in letter property 58,000 rupees and in SOP it is nil. Less 30% standard deduction 17,400 in case of letter property and nil in case of SOP. Now the balance is in case of letter property 40,600, in case of SOP it is nil. Now we have to deduct the interest. Less interest in case of letter property 3,500 rupees, in case of SOP it is 8,000 rupees, that is allowable. Now the balance income will be 37,100 in case of letter property and in case of SOP it will be minus 8,000 rupees from house property. Thus the total income from house property will be 37,100 minus 8,000 rupees equal to 29,100. The total income from house property will be 29,100 rupees. Thus the income from SOP is minus 8,000 rupees. Annual value. Deduction under section 24 8,000 rupees for interest. Loss 8,000 rupees. This loss of rupees 8,000 can be set off or adjusted against the other income available to the assessee in that year. That is, loss from HP can be set off up to 2 lakhs rupees only, or if it cannot be adjusted, it will be carried forward and given set off in the next 8 assessment years immediately following or succeeding the assessment year for which the loss is first computed. This loss can be given set off in the next years only against the income under the head income from house property. It may be noted that if the loan is obtained for other purposes than for constructing or acquiring the property, say for purpose of marriage of daughter or purchase of furniture in the building, etc., then the interest is not allowable. This is to be noted here because sometimes such types of information may be given in the question paper. If you like this video, then please press the thumbs up icon and subscribe the channel, which is free of cost, and press the bell icon next to it for getting the notification of my next video. Thanks.